All right, welcome everybody. Here is my 2025 housing market forecast. Now, listen, I'm going to break down some things that we either know kind of from trends going from last year into this year, plus talk about what some of the leading experts are saying. I'm going to add some of my own thoughts on it. But stay till the end because at the end, I'm going to basically talk about a few things that could throw all this stuff super sideways. That being said, let's start with what we kind of know, where we've been, and where we're going. All right, without further ado, let's kick it off here. So listen, Greg, who's the chief of financial analysis over at Bankrate, he said most areas will still lean towards a seller's market due to limited inventory. However, those markets that have seen a surge in inventory will definitely be more of a buyer's market and will be susceptible to price declines. I mean, look, that's the oldest rule in the book, right? He's just basically saying supply and demand. So if you have solid demand and your supply goes up, prices usually go down. And if prices go down, then it's usually more of a buyer's market. If the inventory is still tight and the demand remains the same or strong, well, then guess what? It's a seller's market. Pretty simple, right? So what I'm going to say is here in like the DC Metro, Baltimore Metro market, I'm going to say it's been a pretty strong demand for the last few years, and it's been a seller's market predominantly because it's been tight inventory. And that's still pretty true overall. Now, there are pockets, right? For example, if you compare Dundalk to, I don't know, let's say Crofton, Dundalk's been moving a little bit slower this past year than, again, say Crofton. Or you compare parts of Waldorf, maybe. So basically, the kind of closer you go to Annapolis or even parts of DC, where all the job centers are, etc., we're seeing a lot of those markets still be tight inventory. A few of the other parts that are a little bit farther out, well, maybe we have a little bit more inventory and things are, taking a little bit longer to sell. All right, Freddie Mac. Well, we expect housing prices to continue to grow, although at a slower pace. And again, they're not saying anything that is surprising here, right? Pretty much the majority of the top economists that I've read and have heard are all saying the same thing, which is, the housing market's going to continue to grow as far as at least like the median price, your home equity, however you want to word it, is the reality is for the past, 50 years or so, housing usually has been a safe bet. The big notable exception, of course, was that 2008 whole meltdown, right? But ever since then, for the most part, housing has grown. The difference is we went from during COVID where we had 2 years of like 20% growth, which is not sustainable and not normal. So, the last 2 years or so, if we're 5% or 8%, okay, well, that's still more than normal, but it was less than the previous 2 years, which is why people are like, oh, it's slowing down. Well, yeah, 20% is not reasonable, right? Nor should we expect it to be. So where should we expect it to be? Well, somewhere probably between 3 and 4%, it would be more normal. So if it's a little bit less than 3, still positive. If it's closer to 5, hey, we're doing well, right? All right, so here we go. Here is actually the chart from some of the top leading experts on what they expect for the home price appreciation. And this is as of January 7th. So this is pretty, current and just, the most recent data that we have. And if we put them first all together, you can see the average of all 21 of these people, we're looking at 2.9%. And that's not bad. Again, look, anywhere like 3 to 4% is pretty normal. Like that's really where we should be. We just had a couple years that were abnormal, that where things are at 20%. Last year, I think we were closer to 5%. Year before, maybe like 8% or 12% or somewhere in there, depending on what area you're looking at. So the point is 2.9%. Okay, so sure, you could say, well, yeah, that's not a lot. Okay, but realistically, it's not healthy to have it be 10, 20% year over year. It's going to make it unaffordable for people to buy homes. So I would love to see this be between 3 and 5%. I think that would be super healthy and more balanced for the market. That being said, just to call out a couple things. So you have, most of the people, Freddie Mac, they're at 0.6%. So they think, okay, it's just going to tick up just a little bit. You got National Association of Realtors at 2%. CoreLogic, who builds a lot of the multiple listing service like backend, and they have appraisal service and a lot of data. They're at 2.4. You got Fannie Mae at 3.6, Realtor.com at 3.7, Zillow at 2.6. Of course, I don't trust anything that Zillow does, but that's okay. You got Redfin at 4%, a whole separate thing. I don't trust a lot of the data from Redfin either. They're out to lunch on a lot of things. Wells Fargo at 4.9. Okay, they're a bit bullish. You do have Morgan Stanley at -2, kind of the outlier. I don't know what they're looking at. Maybe they're still feelings are still hurt from 2008. I don't know. That's a bit of an outlier, but overall, pretty positive. So if we're around that 3%, that's solid. All right, so rates were abnormally low for the better part of 15 years, and they've been abnormally high for the last 2. They're coming down, but where they'll settle out is going to be a level that's higher than what we've seen since before 2022. So here's the thing, for the last couple years, let's say last year and a half, 2 years, once the rates started going up, everybody, including myself, was kind of thinking, okay, hey, they'll go up for like a year or so, and then they should start to come down, right? And that's because of there was a lot of different reasons why we thought that, but that's for another video. I'm going to just simply say that's what the leading thought was. And even a couple months ago, when the Fed just started lowering the short-term borrowing rate, there was speculations from a lot of big banks and a lot of various financial researchers and analysis and all these people that basically were saying, oh man, we think the Fed is going to drop their rate anywhere from like 6 to 8 times over like the next year or so. And people are like, oh man, this is going to be great. Rates are going to be coming down, and people are pumped up. It was awesome. Everybody was super excited. And then the jobs market came out. And then there was some other data, some inflation data, and some other reports came out. And all of a sudden, people are like, ooh, wait. And there was this sort of knee-jerk reaction. The upshot, and without getting too technical and worrying about all those little details, I'm simply going to say that the end result was, although that the Fed did recently meet and did, we have lowered the interest rates overall, it's not so much what they did, but it's what they said. And one of the things that they basically came out and said, they're like, where we were thinking we were going to drop the rate a lot more next year, being 2025, they now were like, well, maybe we'll do it twice. So we went from kind of thinking, hey, we might be dropping it 6, 7, 8 times in a row, to now we're only thinking maybe twice. Now we're starting to think, okay, maybe the interest rates are going to be higher for longer. Maybe we don't see them really dropping a lot lower until 2026. The reality is no one really knows. We did just have another jobs report. I don't have that data in here, but we did have another report that just came out, and it was better than expected. You might say, oh, that's great. It is great, except for when the jobs reports are better than what they expect, and when we're talking about the Fed doing what they're doing, that actually is bad for us. It sounds funny, but it's one of those things where the Fed is still very much afraid of inflation, and with the jobs market being better than expected, they're saying, okay, our economy is not slowing down, and they want it to slow down a little bit in order to do what they're doing. So again, that kind of gets into the weeds on economics, but for our conversation, what I'm going to say is we're not getting down to 2.5%, 3%. And realistically, maybe this year we don't see the 5.5 that people were hoping this year. This might be a high 5s, a low 6s kind of a year. And it just might be what it is, which historically is great. It's just kind of painful after the couple of years that we had of seeing some really low rates. So with that being said, what does that look like? Here we go. Mortgage rates and projections. So just like I said, between that 6 and 6.5, that's where they're projecting, right? You can see at the bottom here, Q1, Q2, Q3, kind of going into Q4. They're thinking maybe we get down to the low to mid 6s. In other words, not a lot of movement, okay? And that's kind of right now what the temperature is like out there. We'll see. things could jump real up. They could also come down, but it's looking like probably less volatile, less movement as far as what they're seeing right now. Okay, and you can see the actual is the orange of where it was. The Mortgage Broker Association (MBA), that's the green dotted one. Fannie Mae forecast, the yellowish, and then the Wells Fargo in the blue. All right, well, here's some of the big people kind of thinking what is it going to look like. Well, the forecast, if you put all 9 together, 6.36. Okay, again, I mean, it's not too far off from where we're at now. So they're thinking it's not going to really come down that much this year. And again, if you asked me this 2 months ago, this data would have been different. It's wild how some of this stuff is changing. You got Redfin, they're thinking 6.8, all the way down to NHAB, 6.12, Realtor.com, 6.2, Bright MLS, which is the second largest MLS in the country, the one that we use. You got Fannie Mae, MBA, Wells Fargo, CoreLogic. Again, right, all of that high 6s all the way down to the low 6s. Okay. This is kind of wild. So the mortgage rates by decade. So historically, where have things been? And if you look at in the 70s, 8.86, 80s, 12.7, 90s, 8.12. It's rough. The 2000s, 6.27. Okay. Currently, they're hitting in like this the high 6s. So we're close to where it's been in the 2000s. Now the 2010s, that's where that 4.9 or 4.09 really, the 2.5-3% is where a lot of people kind of refied, but again, that's an average. So we're not getting back there. We may never get back there in our lifetime. It's quite possible we may not. Inventory should continue to grow this year. So this is pretty wild. If you look nationally speaking, there was an increase in inventory, which is great. We need that. We need more, right? So this is year over year existing homes for sale, inventory change. And again, this is not new construction. This is existing home sales. You can see the 2024 full year inventory change expectation. They're still wrapping up some of that data, but they're thinking it's roughly 15% higher than 2023, which is awesome. Because look, 2013 to 2019, you can see we dropped minus 3.6%. 2023 versus 2022 was brutal, minus 4.4%. You hear a lot of agents and a lot of buyers out there complaining, oh, there's no homes to buy. Well, you can see it, minus 4.4% compared to the year previous to it, right? So more inventory, 2024 is awesome. Well, what about 2025? This is our 2025 forecast after all. The forecast is showing roughly 12%. And about a month ago or so, you had Lawrence Yun, chief economist of NAR, and Brian Buffini, who's a big real estate coach. They were talking. They do their bold predictions for the 2025, and they were in this like 11 to 13% kind of range as well. So again, that's kind of what a lot of people are kind of angling is around that 12%, give or take. And so if you're thinking about buying a home this year, maybe you have a few more choices. So that's good. Mortgage rates have averaged above 6% for the past 24 months. Buyers are no longer waiting or expecting mortgage rates to fall substantially. Furthermore, buyers are in a better position to negotiate as the market shifts away from a seller's market. And that's Lawrence, again, the chief economist for NAR. So look, you got to take that with a grain of salt. Every market is unique. Every market is local. And some spots you can't negotiate much at all. In some other spots, you can do all kinds of things. Everything is very, very hyper local as far as your negotiating power. That being said, I think it's important to note that really, if you look for the past 2 years, our rates have been over 6% on average. And if we look at what Powell from the Fed was just recently saying, it doesn't look like they're going to be doing anything that's going to help get the rates lower in 2025, at least not substantially, to move the needle there. And I think the rest of Wall Street is kind of responding in kind. The reality is one of the things that people, unless you're kind of nerdy into this stuff, people don't talk about much is the fact that the federal government purchased a lot of loans, a lot of mortgage-backed securities, a lot of bonds, all these kinds of things uh, during COVID. And so their balance sheet has a lot of debt. And they still need to sell a lot of that stuff off. And they want the private sector, they want Wall Street to buy the stuff. And Wall Street is not buying it as quickly for as much money with rates that would be attractive to us. And so we're the Fed, the Treasury, etc. They're all still sitting with these high balance sheets, and they're still selling stuff off. And as long as that's going on, I don't think our rates are going to come down to where we want them. That's my own personal opinion, not an economist, but that's what I think. All right, 2025 is poised to continue the trend of rising inventory across the country. We'll probably finish 2025 with 15% more homes available than we have now. That's the Altos research. Again, he's at 15%. It looked like Lawrence from NAR, they're closer to 12%. Okay. But again, 12%, 13%, 15%, hey, I'll take it. I don't expect us to have 20 or 30% more homes. That's unrealistic, right? It's not reasonable with just where things are. But if we could get 10, 12, 15% more homes, hey, I think that's great. We need it. Existing homes for sale inventory forecast. So this is, again, year-over-year price increase. And they just compared Realtor.com, 11.7, who are following Lawrence Yun with NAR, against Alto, so 11.7 versus the 15%, which is just a little bar chart saying the same thing I just said. Sorry, the stuff kind of got scrambled there. I don't know why I did that, but that's okay. So total home sales forecast to rise. So this is cool. So this is if you take the existing home sales forecast plus the new construction forecast. And this is where you can see that projected at that 5.1, and this is in millions. So 2019 to 2025. So you can see where, years ago we're 2019 at 6 million, and then 6.5 million, 6.9, 5.7. So right here, I'm moving my mouse. You can't even see it. The 4.6. That was 2024. That was our valley. We're hoping that was our valley. In other words, we're hoping that was the slowest amount of volume of selling new construction and existing homes in quite some time. And if we could get back to 5.1, look, is it 6.9? Is it like, some of those glory years? No. But hey, 5.1, we start trending in the right direction, right? It would be nice to have some more homes to show our clients. So that'd be great. So taking a little side note here. So consumer debt is at record levels. There's a few sidebars here. I just want, because we've got to put all this together because that affects, do people have the buying power? Can sellers afford to sell all these things? And so I think it is important to know, kind of coming out of COVID, you can really see the consumer debt is kind of getting out of control, and that's not healthy. I don't have the solution for that. But I do think it is relevant when we're talking about the housing market and the overall economy. I think it is important to just kind of at least note, right? So total debt balance and its composition in trillions. You can really see the mortgage kind of, again, in 2022 starts ticking up, which, yeah, look, housing prices got more expensive, right? So that ticked up. But also look at auto loans. Started kind of the last few years, I think, just with all the computers and sensors and all, like your cars got more expensive. You can kind of see some bumps there. Again, coming out of COVID, people, I think, relying on their credit cards a little bit more. And of course, if you look at the last 10 years, the student loans have been out of control. You go back to 2010 or so, it's not bad, right? Look at this small little piece there. But right now, the people's student loans are making up for as much as their auto loan, which is kind of nuts. So the good news, home equity is far outpacing the mortgage debt, and this is in trillions, okay? So if we look at the total homeowner's equity position versus the home mortgage debt, the yellowish-orange is that home mortgage and the total homeowner equity. So in other words, our appreciation for the last decade has been nicely going up. Again, some weirdness during COVID. You kind of see it up and down and some little funkiness there. And also just in 2022. But overall, the Mountain Trillions, the yellowish line, yes, it did tick up, but that delta has been solid. And if you go where it got inverted, that's back in the 2008, right? That 2008 to 2012, you can see where that inversion happened. But we're not there, right? So ever since 2012, appreciation has been going up. Yes, the mortgage debt amount has gone up, but it's far behind what our equity position is, which is great. All right, equity growth has begun to moderate along with the broader home prices in recent months, but that's still the largest volume of equity we've seen on record. Adjusting for seasonality, the average homeowner now has $319,000 of equity in their home, of which $207,000 could be borrowed against while still maintaining a 20% equity cushion. And this is the ICE Mortgage Monitor report. Well, you got to take this with a grain of salt because obviously, if you're in an area that has a $350,000 average home price, then this doesn't really make any sense, So this is on a much more macro level. But I think that the relevance here is what they're just saying is that people, as a general rule, have equity in their home, and that's great. So even with higher interest rates, even with mortgages for larger sales prices, etc., exist, the reality is people have more equity with the way homes have appreciated in the last 10 years. And overall, that is good for Americans that are homeowners. So let's talk about foreclosures for a second because, the last couple of years, people keep saying, oh, I'm going to wait for prices to come down, or, oh, I'm going to wait for all the foreclosures. So let's talk about that for a second. For a homeowner in the early stage of a foreclosure, that equity helps them avoid a foreclosure sale, either by leveraging the equity to pay down and past due mortgage bills or by selling their property in order to protect the equity they'd otherwise lose at the auction. And that's founder and CEO, CJ Patrick Company. Okay, so it's kind of like things Captain Obvious, right? The general idea here is if you don't have any equity and you can't pay your bills, you just let the bank take your property. If you have equity, then you don't necessarily have to get foreclosed on. You can just sell it. And that's basically what they're saying, which is part of the reason why even though some people have hit tough times, we're not seeing as many foreclosures as one might think because people have equity. So serious mortgage delinquency rates remain low. Percent of mortgage balances 90 plus days delinquent through the Q3 of 2024. So you can see, that again at the bottom, that 2008 debacle, right? All this stuff spiked up, and then over the last 10 years, how it's been trend, it's come down. Now you might say, okay, what about that 2021, 2022 COVID? Well, look, around then we had a moratorium on foreclosures for a little bit there, so we weren't doing a lot of foreclosures, and then there was, in 2023, 2024, you saw some headlines be like, oh, foreclosures have doubled. And it's like, yeah, we went from nothing to a little bit. And then we went from a little bit to double of a little bit, which is still only a little bit. And that's basically what the story is here, right? So if we, sorry, I didn't mean to hit that. If you look at the bottom, of course, I can't see the mouse in this view, but if you look at that trend line, yeah, okay, we're ticking up, but we're still below where we were pre-COVID levels. So we're okay. That's great. So in other words, we may see some more foreclosures, but we're still not even back to where we were pre-pandemic. And I think overall that speaks to the housing market being pretty resilient. In October 2024, the U.S. housing market experienced a slight uptick in foreclosures activity, with 30,784 properties filing for foreclosure, making a 4% increase from the previous month, but an 11% decrease year over year. This nuanced trend shows foreclosure levels remain relatively low despite monthly rises. Again, just goes back to people have equity. All right, U.S. foreclosures activity decreased in Q3 2024. U.S. foreclosure starts in Q3 2024. So again, there it is. I was just talking about the foreclosure moratorium in 2021, right? So the end of 2020, going into through 2021 into the beginning of 2022. That's why the levels were super low. So yeah, shortly after that, do we see the numbers double and go up a little bit? Yeah, again, because of the moratorium. But look at that. It's still below pre-pandemic levels. And it's getting close to that level. But okay, I don't think that's necessarily bad, right? If you don't pay your bills, then at some point the bank is going to want their equity or their collateral. So it makes sense. Big picture, where do we see things then, right? So in other words, yeah, we'll see some more foreclosures, but it doesn't look like a whole lot, right? It looks like interest rates somewhere in the sixes, probably, 6.25, 6.5, would be a fair assumption this year. So definitely not the fives that people were thinking, even like a year ago, we were hoping we would already be back there. We're just not. I don't think it's going to happen this year. I do think it does look like we're going to have more inventory, which again, hey, more inventory, that's great. I'd love some more inventory, but I don't think it's going to be a gluttonous of inventory. Now, those again are all the things that are like sort of pure empirical, normal economic data that we can kind of point our finger on, right? Here's the big but. And I don't mean to get political, but what I'm just going to simply say is we have some big unknowns that are coming in the next couple of years that really could affect things. The first thing that I want to mention is there's all these fires that were just going on in California that just wiped out a whole bunch of homes. And my heart is sad for all those people and, all the memories and everything that they've had. But if other than, feeling bad for them, I'm going to put the emotional part aside for the moment and just talk about what does that mean to us? We're over here on the East Coast, and look, I have family who just lost their house over there. But let's put again on emotions for the side for the moment and just simply say, okay, well, there's a bunch of people who just lost a lot of money. Insurance is probably going to take forever to pay some of the stuff back. Some people didn't even didn't have the fire insurance because some of the carriers started removing that a few months ago, which seems kind of criminal to me, but it is what it is. But that could also make things more expensive, right? If you want to build a home, how many, over the next couple of years, if there's a whole bunch of people building homes out there, it's possible that the cost of lumber could get more expensive, or certain things that you may, I don't know, I'll just make this up. Let's say there's, 1 million faucets that are made. I have no idea how many faucets are made. But let's say there's 1 million faucets that are made. Well, how many faucets do they need to get to start building new homes for all these people, whether they build it in California again or where they build somewhere else? All those things could get more expensive, right? So that's one thing to sort of, again, I really don't know, but I'm just kind of pointing out that a lot of people just lost their homes. I think that could have effect on us, number one. Number two, the concepts of 25% tariffs. Again, look, I'm not an economist. I've been in the real estate game a good minute, and coming up on, this is my 20th year. It's pretty crazy. Got my license in 2005. So I've been paying attention, and the idea of a blanket 25% tariff is bonkers to me. And again, without going in too much into the weeds, I'm simply going to say that could have very large impacts, a domino effect type of things. There's a lot of things to build homes that we need. And even if you say, okay, well, we'll get U.S. Steel. Okay, great. Well, how long will it take the factories need certain things or machines or this or that? How long will it take for them to spin up and get all that stuff? A lot of question marks. And meanwhile, that stuff could still cost more money why that happens. Or lumber. Look, we might get a lot of lumber from Canada, for example. Well, do you want your 2x4s and 2x6s to be 25% more expensive? Maybe you were thinking about adding on a deck. Well, that may get more expensive, right? Maybe you want to finish your basement. Again, that could get more expensive. And truthfully, a lot of the housing stuff I think is already too expensive. And so a blanket 25% tariff, if that actually was to happen, I think could have some serious negative impacts on people doing upgrades to their homes, sellers wanting to prep certain things, and buyers wanting to buy new construction. And if we do that, we could see a pause or maybe even a depression in the housing market. All right, so so let's pretend the tariffs, let's say we don't actually get the 25% tariffs at a broad thing. If they're more, let's say, surgically used, okay, then maybe it doesn't hurt the housing market fully, right? Tariffs can be good if used properly. There are sometimes you want to get some fair trade or some negotiations and things going on, and that's cool. I get it. Again, blanket 25% across the board, that makes zero sense to me, but we'll see. So moving past tariffs, let's pretend that doesn't happen. Let's pretend Trump's administration uses that more as a negotiating standpoint and that we're okay. Awesome. Okay. Moving past, what's next? Well, if you listen to Elon and Vivek, they're talking about that they want to reduce, the federal government. They want to reduce the size and the spending, like $2 trillion. There was talk about wanting to reduce, what was it? It was like 130,000 jobs or something crazy in like the DC metro market for the federal government. I mean, it was a huge amount. I don't remember the exact number, but it was they wanted to really reduce the size of the workforce in DC, and not that is necessarily going to happen. A, and B, not that necessarily is going to happen overnight. But if that kind of talk and those things kind of happen, that can very much have an impact in the DC metro market. The reality is a lot of the jobs and a lot of the housing, I feel like people have some kind of touch with the federal government in our area, whether it's directly, whether it's support, whether it's a contractor. So it doesn't necessarily mean like we're going to lose all these houses or all these people per se, but if some of those people go away or their jobs go away or they get relocated to a different state, well, some of the support, whether you're working at a restaurant, whether it's a teacher, whether you're a nurse, whatever, there's all these support kind of things that all support those people and those activities. And so and again, I don't think this is going to happen overnight. That is extremely difficult with the federal government, just the way it's set up. But I just kind of want to point out that, hey, that can affect us, right? So it's important to note that. Being in the DC area, the rest of the country, they probably don't care as much. I just saw an article, actually one of my buddies sent it to me in WhatsApp, said it was an article about one of the new congressmen trying to propose a bill. Again, it hasn't been passed, but their proposed bill would basically, they want to get they want to decentralize some of the workforce for the federal government out of the DC metro area. And they were doing things like, hey, you have to remove like 30% of the workforce to other locations. You can't pay them to incentivize to leave. You can't do all these various things. And look, the particulars don't matter for the moment. The point is that, again, there's talk and pressure to potentially try to move jobs out of our area. And, look, just straight up, if you want to move out of our area in terms of putting pressure in terms of jobs, that's not good for our housing market in terms of if you are looking to sell or if you want to, gain equity, that's not good. If you want to buy, okay, well, hey, maybe put some more houses in the market, right? Maybe it gives you another opportunity. But overall, that's I don't think that's great news if you live around here, which I do. So we'll have to keep a watch on that. Again, there's a lot of things that would have to happen for all these things to pass. None of it may happen. Some of it could happen, but they're all factors that I think we have to, we have to pay attention to. You also still have stuff in Ukraine and Russia going on. And if we back out of supporting Ukraine, whether you believe it or not, again, these are all factors that can affect us. And there's a lot of funky stuff going in the EU, right? You even have our friends up north. Trudeau just is stepping down because he's lost the confidence of his party. So there's a lot of changes going on, and a lot of people are still I'm going to say, reeling from just the cost of goods being expensive after COVID, the supply chain issues, grocery stores starting to charge more, people charging more, etc. And things are expensive. Life has been tough the last couple of years for a lot of people. That being said, the jobs market's been strong, income's been strong, but there's a good argument, I would say. If your food costs way more, if your childcare costs more, maybe the little bit more that you maybe made at work isn't enough to cover it. So people are it. Yes, the economy is better in some ways, but in other ways, people, as you can see by the consumer debt, it's been tough. It's been tough for a lot of people. So all that in a nutshell is to say this: no one really knows what's going to happen in 2025. If we don't get into any other kind of crazy war, if we don't have a huge 25% general tariff, if we don't do, if we don't lose 30% of our workforce for the federal government in the DC metro market, if we don't do things like that, then it's fair to say the reasonable expectation are all the slides, everything I just talked up in the first part of this video. If these other things happen, all bets are off. So that all being said, I will end this with saying overall, I'm optimistic about 2025. I think there'll be some more homes on the market. I think if you are waiting for an affordable home, they kind of don't exist anymore. If you're a first-time home buyer, it's still going to be a very tough market. If you need to sell a home first, or like contingent, it's still going to be very tough because it's still kind of tight inventory, and so they're not going to want to take a home sale contingency. I don't think that stuff's going to change. But I do think there'll be some more choices. I think rates will maybe come down slightly. And hopefully over the next couple of years, things normalize. And we'll get more inventory on the market over the next 2, 3, 4 years. And hopefully rates come down just a little bit more. And things will kind of balance out. So that's my best guess. Let me know in the comments what you think. Thanks for watching. I'm Brendan Spear with Caprica Realty. And if you have any questions, want to discuss a strategy or something, give me a shout. Love to talk. Take care.